Hello and welcome. Today we are going to go over the lab for Unit 1. If you recall, I had given you 8 transactions to put into our tabular format, and then you were to prepare financial statements from them. So let's go over and take a look at what we're talking about. So you should pull this out somewhere and either set it in front of you or have access to it. Because I'm going to be reading off of this and then showing you what it should look like. So I'm going to pull this over here and put up our tabular format. And again, I start with the accounting equation, right? Assets equal liabilities plus equity. And again, equity is comprised of 4 things. Owner's capital increases it. Owner's draw or withdrawals decreases it. Revenue increases it. Expenses decrease it. And if you put revenues and expenses together, that becomes net income or loss. And these 3 items, right, capital, withdrawals, and net income or loss, it is the owner's capital that carries forward from period to period. So let's go ahead. I'm going to just read off these and put them where they belong. So my balances are all 0 starting because it's a brand new business. And I can change any of the assets or liability accounts to reflect what's going on in her particular business. So the first thing, she invested $11,000 cash in her business. So $11,000, and the accounting equation is still in balance. Now, when we did this before together, every single time I balanced everything, and I did want you to do that. I'm not going to actually take the time to do that, but you would literally do that. So number 2, I paid $800 for July rent on office space. So that decreased my asset of cash by $800. And my expense account went up, right? My rent expense. But what does expense do to equity? It decreases it by $800. So you can see if I were to balance here, both sides of my equation are still in balance. Number 3, I purchased office equipment on account for $3,000. The key here is the words on account. You did not use cash. Instead, you told them, hey, I'm going to pay you later. That's what on account means. That's a liability. Remember the word payable. Whenever you see the word payable, that means a liability. So my liabilities went up $3,000 and my office equipment went up $3,000. Number 4, I provided legal services to clients for cash of $1,500. So I got cash. Awesome. So that went up, right? Because I received it. It made my asset go up. And that's what I'm in the business of doing. That's how I earn my revenue, is providing legal services. My revenue account, of course, went up, and revenues increase equity. Number 5, I borrowed $700 from the bank on a note payable. And if you recall, the difference between accounts payable and notes payable is that notes payable has an interest rate and a formal promissory note that's signed, both parties sign it, and it's a legal document. So my cash went up $700 because I just borrowed it. And my liability of notes payable just went up $700. So if I were to balance here, I would find that my assets equal my liabilities plus equity. Number 6, I performed legal services for a client on account. So again, there's those words, on account. But this time it's not an expense because I'm providing the legal service. That's a revenue. So I'm going to come out here and increase my revenues by $2,000. And what is it over here? It's an AR, accounts receivable. And again, whenever you see the word receivable, that indicates an asset. You have a right to receive something, and that is an asset, okay? Number 7, I paid monthly expenses. I paid salaries and wages of $500, utilities of $300, and supplies of $100. So that looks like that was all of a cash, because it says I paid monthly expenses. So those totaled $900. So my cash went down, my asset of cash went down $900. And I had expenses. And of course, expenses, the actual accounts of salary and wage expense, utility expense, supplies expense, all went up. But in general, expenses make your owner's equity go down. And then lastly, Joan took out $1,000 for personal use. So again, my asset of cash just went down, so minus 1,000. And drawing owner's withdrawals, we know that that decreases equity. So there's all the accounts. So I'm gonna see what my balance is when I'm done with the whole month. So I've got 10,500 in cash, no asset of supplies, 3,000 in office equipment, and 2,000 in accounts receivable. So I can see that I'm going to just total this up, make sure it's all balancing. My total assets equal 15,500. Then over on the liability side, I've got accounts payable of 3,000, notes payable of 700. My capital account is 11,000. My drawing was 1,000, and it looks like revenues were 3,500 and expenses were 1,700. So my net income was 3,500 minus 1,700 equals 1,800. So let's make sure my liabilities plus my equity have to equal my assets, right? So I'm just doing a check here. Oops. Okay, so 15,500 are my assets, and 3,700 plus 11,800 are my liabilities and owner's equity, and they balance. So that's great. Now we're going to do our financial statements. To review, you have to do them in the following order: income statement, statement of owner's equity, and balance sheet. So my legal service revenue was $3,500. I got that from here. Some of it I got in cash, some of it on accounts receivable. Then my rent and your expenses go in alphabetical order. So you start with the subtitle of expenses, and then I'm going to put those in the column here and then pull them over to the right. So my rent expense was 800. My salaries expense was 500. My supplies expense was 100, and my utilities were 300. So to total up my expenses, it looks like the total of these four numbers, I know they're going to be 1,700, right? And that gives me net income of revenue minus expenses, $1,800. And when you get to these big numbers in your financial statements, you should put a dollar sign on them. I don't think we need any pennies. And then double underline it. That indicates that you're that's a final number, right? So we needed that number, right? The 1,800 to do the statement of owner's equity. Okay, let's all say the model together. beginning capital plus, there's two things that we can add, investments and net income or loss. If it's a loss, it's a negative number. And then less our withdrawals. Okay, so beginning capital, it's a brand new business, so it's 0. But remember, if it's a business that's in anything other than the very first month, your beginning capital will be whatever the ending capital was from the prior period. So it looks like we're in July, brand new business, it's 0. Okay, let's go back up here. What were my investments? 11,000. So plus my investments. And again, because there's a subtotal here, I'm going to move in one column to the left. And then it's plus net income or minus loss. And we just figured that out up here, right? So you can just pick that cell up. It was $1,800. So what is our total of the items that we're adding on? The total of these two numbers. Now my withdrawals, I go up here. What was the total of my drawings? $1,000. So $1,000. Oops, wrong cell. Therefore, what is my ending capital? My ending capital is beginning capital plus investments and net income minus drawings, $11,800. Dollar sign it and double underline it. And again, the reason we do things in this order, we need our ending capital number because that is our equity number. So now we're going to do our balance sheet. I do want to point out that the P&L is for the month ended. That covers a period in time. The statement of owner's equity for the month ended, it covers a period of time because you can see all these things happen. Balance sheet does not cover a period. It is a snapshot of a point in time. So you just put the date. Okay, so we've got 3 assets, right? Cash, office equipment, and accounts receivable. So let's list those under assets. Cash, accounts receivable, and office equipment. Okay, move this over a little bit in minor column. Okay, so my cash was 10,500 and my equipment was 3. 10,500 and my AR was 200. No, 2,000, sorry. Okay, and then again, we're going to total our assets over here in the next column. So we need to have a label, total assets. And that is the sum of these 3 numbers, 15,500. And we knew that because we've already seen that, right? Liabilities, we had 2 liabilities. We had accounts payable. And so now we're getting to the point where we're sophisticated enough to just call accounts payable AP and accounts receivable AR. And remember, receivables are assets and payables are liabilities. And here's our notes payable. And I've got to go up and get my numbers for that because I don't remember what they are. Okay, AP was 3,000 and notes payable was 700. So I'm going to do a little column to the left here because I've got to have it subtotal them, right? And then my total liabilities are these two numbers. And now the moment of reckoning, I guess I should put this down here so it's easier to see. Right next to each other. The moment of reckoning, we know that our accounting equation is total assets equal liabilities plus equity. So my last subtitle is total liabilities plus equity. And I have to add up my liabilities and owner's equity equals this plus this. 15,500. Life is good. So hopefully at this point, after this chapter, you should absolutely be able to analyze transactions. You should know this model inside out, right? Assets equal liabilities plus owner's equity and the four components of owner's equity. You should be comfortable with the fact that revenues minus expenses equals net income, and that capital, beginning balance capital minus withdrawals plus or minus net income is your ending balance for equity. You should be able to do your financial statements, so you need to memorize these three models. So that's where you're at. You have to memorize the P&L, the owner's equity, and the balance sheet. And then the last thing that you need to know is how to calculate return on assets. We practice that at the end of the second lecture, and that is net income divided by average total assets. And that tells you how well your company's performing. So if we did that on the company we just did, take a moment, turn off the tape, and see if from the financial statements you can calculate return on assets. Shut off the tape, take a moment, find the numbers, and I'll meet you back here and we'll go over it. So, welcome back. Return on assets, the calculation is net income divided by total average assets. So I go to the P&L to pick up my net income. I go down to the balance sheet to pick up my assets. 1,800 divided by 15,500 gives me 0.116129. So to be clear, that is the same as 11.6%. And your return on assets, the number is identified as a percentage. So you need to convert this, the 0.116 to a percentage. And that means for every $1 of assets, you're generating 11.6%, 11.6 cents of net income. So we looked last lecture at Nike, I think, and Under Armour. So what a company does with this number is they track it period after period to see how well they're doing. Are they yielding net income from their assets? So that is a wrap on the first chapter. Let me know if you need any help with anything, and I will see you in the next chapter. Okay, bye.